A board begins when the owner gets tired of playing the role of the smartest person in the room.
In your opinion, is a board generally useful for private businesses or not?
Abroad, the practice of having boards is widespread, and it's just like hygiene there. If you analyze the reasons for defaults after 2012, about 70% are actually due to conflicts between owners. A custom board can change the fate of a company. When I, as a banker, see a company that has created a board, I always have very specific questions for the owner and the board.
Ladies and gentlemen, welcome to the Boards of Directors with Sergiy Bulavin channel. Today our guest is Ruslan Spivak, PhD and expert in international finance and economics. Good afternoon. And today, together with Ruslan, we'll discuss the views of bankers on boards of directors, on supervisory and also on advisory boards in business. Ruslan is a banker, and throughout his work he often encounters companies that have boards, where the owners have implemented them, and probably for a banker who has a rather structured and regulated approach to boards, probably what happens in private companies is simply a nightmare for a banker.
Yes, sometimes we come across different cases, but what's encouraging is that the situation is improving.
The number of nightmares is reducing.
The fear is becoming less, but I should note that for the last 10 years, I hold lectures for MBA graduates, both in Ukraine and abroad, either in Oxford or in London, and I create a single slide, one slide that somehow reflects the current reality, the global reality. If we look at it, the challenges that are added every year, they create a necessity. Board simply becomes like hygiene already, because essentially we have a war, we have, after the pandemic, essentially constant unsafety. We are witnessing a digital shift. Artificial intelligence is now everywhere, and it's not just hype, it's already an integral part of business operations. We can note that there is a complete change in the behavioral model of the economy, of customer expectations, and the regulatory aspect is becoming very strict. And in fact, all these factors are contributing to what we can observe as a certain crisis, if we can put it that way, in strategic and tactical planning. Before you could simply say, yes, let us go ahead and create some kind of adaptive model. Now the board creates an extra brain that can modify this model to adapt it to these challenges in a more effective way. And in fact, you get a greater chance that your resilience and your module will be higher under current conditions.
I recently spoke with foreign board members, and they were surprised. Is this happening in Ukraine? Owners are creating boards not just to attract funding, because for some reason they had the mindset that a board in a private company, where it's not necessarily required, according to the country's legislation, can only be established when it's a requirement from either an investor or a potential lender. But in my experience, virtually all the boards that were created, and I've been involved in setting them up since 2019, almost all of these boards were not for attracting funding. They were for development, for resolving certain issues between owners or at the strategic level within the company.
Yes, that's absolutely true. I still say that a board begins when the owner gets tired of playing the role of the smartest person in the room. And at that moment, when they realize it, they see that their own perspective has certain limitations. There is a certain trajectory that no longer reaches the goal, that no longer allows the company to achieve the objectives it has set for itself. This is when the board appears as an extra person. When it comes to financing, there's a different specificity. I participated in several very large projects for our country, when in fact, for me, it was very difficult, but I managed to convince the owner that to secure major financing, a significant amount of groundwork needs to be done, and part of that work is forming a board, made up of professionals, not just well-known names, but also professionals who can provide more added value to the company, and significantly shorten the path to securing substantial funding. And I can say that, as always, one failed. But there are three very successful and well-known cases in Ukraine with investments of over $50 million received from either local or international organizations. Then the board played a very important role, a very important one.
And probably, indeed, there is some proportion of boards that do not bring added value, and probably there are reasons for that, mistakes made during their formation or errors in the way such boards operate, and there are boards that do bring value. Overall, if we look at the general statistics, based on your experience, how useful do you think a board is for private businesses, where it's not necessarily required by Ukrainian law, Is it beneficial or not?
I believe it is. But certain prerequisites must be established from the start. That is, the owner's mindset. They need to be ready for the fact that a board will be introduced. Whether it's an advisory board or a supervisory board, to be honest, I'm not a big supporter of the standard classification by the World Bank and others and so on when it comes to certain structuring of what kind of board is needed for a company at a certain stage. I tend to believe more that we live in such a constantly changing environment today that there is no such thing as black and white. In other words, there's a certain combination, a mix. Often, yes, we can classify quite clearly that for small businesses, an advisory board is more promising. They are more prepared for it, while supervisory boards are more suited to large corporate clients. But if we don't absolutize these terms, then what can we conclude? When you're facing challenges every day, and often these are existential challenges, then the experience that has already been formed within the board, when people have gone through 20, 30 years of similar challenges, becomes invaluable. And I always say, even without looking at the world, just in Ukraine, unfortunately, every few years there's either a change of government, or a Maidan, or a war, unfortunately, yes. And all of this leads to the absence of stable development. That is, limited linear thinking simply cannot be adequate in this context. So, to put it briefly, the board is truly important. The timing for creating a board must be chosen very carefully. If the ground is unprepared, the board simply won't be accepted, and it will lead to more conflicts. And in fact, it could even result in the death of the company. And there's a very interesting statistics. I'm a little bit there too. In almost every such local presentation, I try to convey this so that the owners understand what the perspective for their business really is in 2, 5, or up to 10 years. According to current global statistics, 20% of companies die in just the first year, 45% barely survive 5 years, and after 10 years, less than 40% remain on the market. And this is a global trend, not just in Ukraine. If you take a closer look, the practice of having boards is widespread abroad. And over there, it's just basic hygiene. And when we see such statistics, when we understand that there is a certain combination of responsibilities between the board, the owner, and the CEO who was hired, it's like an orchestra. It has to work quite harmoniously. I was surprised by one figure, and it really shocked a lot of people. 50% of listed companies in the EU are zombie companies. These are companies that haven't generated profit for over 3 years. That's striking. Very clearly shows that just having a board is not a guarantee that your company will grow in a profitable direction or that it will follow the planned course. So in short, yes, but you have to take a lot of conditions into account.
Well, and likely, a lot also depends on the readiness of the owner, the top management, and the legal structure of the company. Ruslan, you just mentioned advisory and supervisory boards, of course, are like two extremes, and many forms of boards fall somewhere between these extremes. My colleague and I give lectures for the certification course, Corporate Director, organized by CGPA. And we use the name advisory boards with the extended authorities. And of course, this format is probably more productive, more effective for private sector companies. But from your experience, can an advisory board in its pure form actually work in a private company?
I think only for a very limited time. That is, I would actually recommend having a board, for example, for the owner themselves or the company CEO. And it's a kind of combination of a mentoring function and company support. But as just an advisory board, and I really do lack genuine accountability. And to be honest, I also lack any real structure. That is, I have a phrase in my head right now. I've never actually said it out loud, but it's something like this. Good companies not only take advice, they also actively try to institutionalize it. And this creation of an institution is precisely the path toward a supervisory board, and this path needs to be taken. So yes, at the initial stage, when a business is being established, an advisory board is necessary, both for the CEO and for the owner. In fact, it's even more important for the owner because we have what I always call Ukrainian optimism. That is, the owner often says, I have a dream, I have a goal, and I'm moving forward. This dream has nothing to do with P&L or cash flow. It's just that I'm moving forward. But then, at the first obstacles, the problem of the lack of capital arises, or the problem of growth, because the company doesn't have enough structural maturity to support the growth trajectory that has already started. And this creates a problem. So at the first stage, yes, the advisory board can exist, but later it needs to be structured, or it should continue in a slightly modified format. For example, it can remain advisory, but it should still be more structured, or it's better to transition it into a supervisory board.
There is generally a perception, perhaps even a stereotype, that a supervisory board is more about oversight and assurance, accountability to stakeholders. An advisory board is more about business and strategy, and the fact that the advisory board does not engage in oversight. The supervisory board, it doesn't often get involved in the business strategy. In your opinion, how true is this in today's context, in today's world?
Considering what we started with, the description of the new reality, I don't know of a single supervisory board that doesn't deal directly with strategy. That is because under other circumstances, you'll simply be running in parallel. That's the best case scenario that could happen here, or even in completely different directions. Because this detachment of the board from the actual business is a problem, even if we look at it from a banker's perspective. I see quite a few boards where, as it's trendy to say now, they're couch boards, right? That is, there are quite a few eloquent experts there who don't have any vision or understanding at all of the specific business they've joined, but they are public names. And it's not even about protection. It's about the hype of having that person on the board. But when we talk about strategy and choosing this trajectory of movement, it's very important to have real professionals involved. And when strategic alignment happens between the owner, the supervisory board, and the person responsible for execution, because we very often lose that execution. We developed a very good strategy. We convinced the investor. The investor allocated money, but everything falls apart at the execution stage because of managerial capacity, structural uncertainty within the company, structural inefficiency. But I would even put something else in the first place. That's culture and managerial capacity. I had several cases in my career when I was offered to join an extremely large project, and it was an M&A that could have been the biggest in Ukraine. And at that time I said, guys, everything's fine, but no. They were surprised because the contract was insane. Ruslan, the contract, take a look, everything's fine. But you and the companies that will be doing the M&A don't have the managerial capacity to pull it off. And it's going to be a failure. A failure is not something either you or I need. So if we can build that capacity, then yes. And are you ready? And all these questions need to be discussed very openly and transparently in conversations with the owner, because often he's not prepared for the fact that he'll need to change the headcount of his company. It's just insane, not even in terms of quantity, but in terms of quality. And it's something, there's even a phrase, I first heard it in Oxford, that many companies, they build their company based on incestuous relationships when you have a CEO or a board, an internal board, or heads who have been working for 10, 15, 20 years, and you realize that they're no longer aligned with the goal you've set, but they keep working anyway. And when you need to make a leap, a kind of disruptive strategy, something different from what you were doing before, and where the supervisory board or advisory board is leading you, it doesn't matter. You need to change those relationships. And that's very difficult. That's why the owner's mindset isn't always ready for it. And it takes a very long journey for the owner to come to that realization. And only after that awareness can you move in that direction.
The first boards, in my experience working with boards, were purely advisory boards, and not a single one of them was able to function properly because all the advice that was given were not being documented. That is, in that practice, we weren't yet doing follow-ups in the board. But the same issues started to come up again after a while, the very same questions, and my colleagues and I in those boards realized that we needed to introduce follow-ups, we needed to implement supervision of the execution, and in fact, this evolved into a kind of board with certain elements of oversight. Although, on the other hand, in the academic environment, the approach of our board, our rules, is quite commonly criticized because it leads to a lack of common standards. Each board is its own separate community, a distinct governing body. When someone says there's a board in business, it's unclear what that board actually does.
Yes, and I had experience starting in 2014 with an Italian company, aside from banking. I was there for quite a few years. Also in consulting, there was an Italian company that had a fairly significant presence in Russia, in addition to Eastern Europe, and they faced the problem of exiting Russia, a complete restructuring. And one day, I know the owner well, I called him and said, Attilio, listen, you have one option. You need to completely change the board now, completely. And look at this problem from a different angle. He took 2 days, and after 2 days he called me. All right, I'm ready. Will you go? I said, this isn't about me, it's about the board. Let's figure out what your North Star is. And I always talk to companies about this North Star, because if you don't take that look into the future, how you see your company, where you want to take it from point A to point B, along which trajectory, with what resources, and with which people, it's not going to take off. Yes, the trajectory may change. War might break out, or some financial crisis may occur, and so on. But the path gets adjusted accordingly. And the board plays a very important role here. Why did I mention the crisis of strategic and tactical planning? Somewhere, a young student in 2003 at Raiffeisen Bank, and I'm sitting there, and someone comes to me and says, create a 5-year budget for individual clients and small and medium-sized businesses. I spent 2 days on it and got it done. After 5 years, we were off by 42,000 hryvnias in the 5-year plan. That's simply impossible under today's conditions. Today, you can't even plan properly 2-3 months ahead, especially if there's a change in taxation rates and terms or other conditions that require a significant adjustment to the P&L. But this is a very vivid example of how much everything has changed. And in fact, my view is that after 2008, after the global financial crisis, quite a few companies started treating their boards more precisely because Enron, Fannie Mae, Freddie Mac, they all had boards. The balance of power and the actual accountability of these boards for the things that were done, they essentially led nowhere. And that's a very big problem and a very significant challenge. And when I, as a banker, see a company that has created a board, I always have very specific questions for the owner, for the board, about how they plan to align their goals, what are the priorities they have, right now, here and today, a year from now, just to at least have some perspective on the future, and that they simply have certain red flags or red lines, as of today, as our enemy says today. And within those red lines, it's then possible to build some kind of development trajectory.
When I started getting interested in boards in private companies, I attended various seminars and trainings. And at one of them, I heard that if a company has a board in place, then it immediately increases the company's valuation by a certain percent. That is, say, EBITDA multiplied by 6, for example, but with a board, it's immediately multiplied by 7. Or if a company has an established board, it becomes much easier for that company to raise money from a bank. In reality, how much does a board actually influence a company's valuation, specifically the presence of a board, or on how easy it is to raise money from a bank?
Let's be honest here. If we're talking about the reality, outside of Ukraine, it's almost a direct correlation. In Ukraine, this is still completely undeveloped, and unfortunately, boards haven't yet become a basic hygiene factor that should be in place. The format can vary, the stages can differ, but the presence of some type of advisory, supervisory, or even a custom board has not yet become a widespread phenomenon. In case when a bank or another financing organization sees that a company has a board, it already creates a certain framework, a structure that shows that, at the very least, there is an approach to structuring the company, to responsible business practices, to business transparency. That approach exists within the owner. And if we talk about our current reality, again, going back to global financial crisis of year 2008, the so-called asset-based financing completely died during 2008. Before that, we could evaluate assets, the quality of those assets, the payback from them, or the investment, the attractiveness of those assets, for example, if a client defaulted or something else happened. Now, if you ask 10 out of 10 bankers, they will tell you the owner is the main asset and the primary subject of evaluation right away. And there are a number of specific characteristics involved here. That is, it includes their transparency, accountability, specific knowledge, managerial level, as well as the level of the staff and company structure they are building. Either it's a group of companies or it's diversified. The relationships built between different companies, whether each is responsible for its own P&L, or there are some transfers, reallocations, and so on, or there is something involving other jurisdictions. All of this is assessed, but when there is a board and you understand who is on that board, how well it is structured, you already get a sense that, come on, there is a reputable individual on the board. A professional with extensive experience, who is a respected individual, is unlikely to endorse anything lacking transparency. And that adds comfort factors for the bank. Yes, when we see the presence of a board today, if we were to create some kind of rating model, there still isn't a checkbox for that in the bank rating models. The presence of a board, there it is. There are qualitative characteristics that stem from having a board, but today I can say that if you're aiming for substantial financing, then without an established corporate governance, your chances are significantly lower.
But from the bank's perspective, is there a difference between an advisory board or a supervisory board?
There isn't a big difference, but when there is institutionalization, specifically a board, it plays a bigger role, and that's definitely a plus. There's a certain issue with advisory boards because we've come back to this topic several times today. It's about responsibility and accountability. When you just give advice, that's one thing, but when a company acts based on that advice and it leads to a result or negative consequences, then you have to take responsibility for it. And that's something I always find lacking in advisory boards. Moreover, over the past 10 years or so, I've seen quite a few companies lose their positions because they were overly dependent on advisory boards. And there have been some very serious defaults in Ukraine, notably involving companies where advisory boards at some point took sides with one co-owner or another, and this created intense conflict. In general, if you look at the period after 2012 and analyze the causes of defaults, around 70% are actually due to conflicts between owners. And within that 70%, about 20-25% are due to boards that were formed in one way or another, but were more like personal advisors to a person, not a company. At the initial stage, they would take the side of one or the other of the owners, and this led to lawsuits being filed and the business being lost. There are a lot of such cases. That's why I'm more in favor of a supervisory board, in favor of it being a clear corporate governance structure with responsibility for specific parts of the company, or as we might say, committees, right? But not all companies have matured enough yet to create these committees, although in practice, when you have a clear understanding that someone is responsible for the financial block or the HR block or for culture, or whether it's a specific board member or a group of board members, it brings peace of mind. So it doesn't matter. In fact, I'll go even further. There's also such a phenomenon as a custom board. And a custom board, I had quite a good experience working and collaborating with such a board. And I even formed one of these boards for a problematic client. That is, it can essentially serve an advisory function or even supervisory or managerial function. And a custom board works very well when it has these functions. Somewhere around 2017, 2018, the first time I created such a board for a company, it was a very good business. Once a furniture manufacturer, the company had a really solid track record, but something went wrong, and they weren't able to service the loan. But I saw such great potential in the company that I just called the owner and said, listen, let's do this way. Banks, especially in Ukraine, almost never do this. This is usually done by investment funds or collection companies, but not by banks. But I said, let's form a board, bring in some bank employees to join it, and help the company get out of this crisis. He agreed surprisingly quickly. I didn't even expect it, because later I had to sell this idea to others, to my CEO and my board. But when I carefully explained to them in detail how this could work and what significant advantages and benefits it could bring, we actually entered into a co-investment in the project. Yes, we didn't pull out any money, but we helped the company get out of the crisis. And after 24 months, a little more, we exited. Yes, we made sure to control who would be the successor. And it's very important for the board to have those successors, because the quality of the company changes, and you need to look for who will replace whom and whether that transition will be seamless. And the company became an exclusive manufacturer later on for the Western European countries, 100% of the orders. I won't name the company, but this is just a story that shows how much a customized board can change the fate of a company. If it hadn't worked out, company would have gone bankrupt, I think, within 6-7 months.
Very interesting. And in this case, the custom board, did it serve more of an advisory role, or was it more about strategizing and leading the campaign based on that strategy?
It actually played more kind of a strategic management role. And I didn't insist that the bank representatives be the actual heads of the board, but they did have veto power over decisions that didn't have unanimous support. And that's exactly why, yes, later, one of the employees stayed with the company. He left the bank and remained with the company as an advisor because he already knew the business so well that it was easy for him and it was beneficial for the company. But if it had just been a strategic or advisory board, there wouldn't have been such a rapid change in quality which was needed at the time. It was simply a 180-degree turnaround for the company.
If we go back to the topic of responsibility, the supervisory board has its areas of responsibility, obligations, and authorities defined in the company's charter. Advisory boards or custom boards usually don't have that. Even if there are provisions for an advisory board, it's very difficult. Within the current legislation, it's hard to grant additional powers and additional obligations to such a board. How can this work in practice?
I always say there are formal and actual rules, right? And you can write down whatever you want, and it might work or it might not. But companies survive when these unwritten rules of the game are embedded in the culture. And when you've reached an agreement with the owner, yes, I would always phrase it something like a mutual agreement, which can even be on paper with the owner, that will regulate expectations and authority, and the terms for termination of activity. Even if this isn't clearly defined in the legislation today, or this type of board doesn't require such formalities, it's often an add-on or annex to that agreement, where I outline the strategy we agreed upon. Yes, it can be updated and so on, but there are goals. And this picture, what we are leaving in the company, because the company already has strong sides, what we need to add, what resources are needed for that, including from the owner, and what we should have as an outcome. This could be a market position, or both a market position and being an employer of choice, or not even or, but and. Specific financial indicators, ROI, net profit, or others that will reflect what you've achieved. This is very important because many boards operate without it, and that later creates an internal conflict because the owner tends to have a short memory. And then he comes and says, yes, we talked about this, you promised me this, please stop.
Is there a document?
Yes, there is a document, and that's important. Yes, these are rare cases because they're not very common, because there's always a certain chemistry between the owner and the board. And it's a cohesive governing team. Make music, not noise. And when you play like the Beatles, that's great. Then if something goes wrong, it's better to part ways. And not to engage in such a strained collaboration, because often boards remain in place while the owner is no longer very satisfied with them and is simply waiting for the right moment to bring it up. But that's a bad practice, because the further you go, execution suffers, since the owner starts calling the top managers and saying, don't do it like that, do it like this. This distorts the strategy, and then when we look back, we just can't understand how we ended up in a completely different place than where we started. That's why I always advocate for open conversation, full transparency, and for a financing organization, it's very important that the dialogue between the owner and the board is established professionally. And during the process, I can conduct an interview with a board member to get feedback about the company. When bankers turn into the CFOs of some companies, they later come back and say, banks don't understand anything about the business. In other words, the business only shows them what it wants them to see. And then they sit there shocked, not understanding how they ended up seeing a completely different picture. But stepping away from that, feedback from the board member can change the perception of the company. If a certain person truly believes in and trusts the owner, and they clearly understand what's going on in the company, even if the financials aren't very good, it will still give me a comfort factor. I will find a solution or another tool to still support this company. There were some very telling cases, especially during this war. There was a case when one of the clients in southern Ukraine, the main owner and effectively the head of the company, became incapacitated, and a rather diverse board was formed, which had both an advisory and supervisory function, and also direct execution powers, a kind of mix. And I was a bit cautious, because the credit limit we were working with was quite substantial. But I took a few people from that board and just had a conversation with them, because owner's son, who is 17 years old, became the head of the company. And that's a tough subject. But when they saw the effort this guy is putting in right now to learn, who as of today is not just the decision-making person, but as well the one who is responsible for execution, among other things. I said, we're not going to exit this company because I can see how things are being done. Yes, we're going to meet more often than once every 6 months, and not just over a casual cup of coffee. We'll be more involved, more precisely watching how this trajectory unfolds. But I believe, and this I believe plays a very important role in our reality. Abroad, I believe it doesn't pass. There, I need a piece of paper, like in that movie. Here, it's a bit different. But whenever I said I believe, not once has it ever failed to work. And that's a really good cultural habit of Ukrainians, to pay towards your debts. If you said we're in the lot, if we said we're in the business, and we are fully dedicated to it, then it matters.
Probably, in addition to the positive aspects of having a board in a company, there can also be certain negatives. For example, if the board's composition is formed in a strange way, or if there are individuals with a particular reputation on the board. Are there any checkboxes related to that? There isn't a checkbox specifically related to the board, but what about the professionalism of the management system, or governance, or individuals with a not so good reputation?
The checkbox here is very simple. That is the first thing we start with again, with the owner, how he selected this board. If this is the case where the owner just saw or heard something, in your interview he said, "Oh, a board, that's cool, we should do that." But he didn't realize that he actually needed it. And he just created this hype for the sake of hype, because it's trendy. That's one thing. The worst is when, in such a format, this board is given actual authority, because the owner isn't ready for it. He thought it was just some trendy concept, and then it turns out you have to align, you have to take steps that are interconnected. So that's one issue. But when the owner realizes the need for a board, when he understands why he needs it, then another question arises. How is it formed and who is on it? And my checklist is very simple. Here it is. First, if the board changes just constantly, someone leaves, someone joins, that already becomes a problematic issue. If I see that there is no clear division of functions, when shaping and launching the roles of the board owner, CEO, and top management, how it's distributed, that's a problem. When I see that the function, which business as a rule is always running, yes, it's running. And there has to be someone who holds it back a little. When this function is skewed toward the business side and is missing either completely absent or a very weak function, which I call risk management, that to me is quite a red flag that the company is moving a bit recklessly. And in 99% of such cases, we see that the internal controls on data KPIs in the company are compromised, that there's a significant gap between managerial and actual reporting. We see some problematic actions when they play all in, and all of this can lead to serious issues. Also, when I see that the board has quite many big names that are well known in the market, but very few real professionals on the subject. I remember well, it was still during the pandemic, someone from a very large state-owned enterprise called me and said, "Ruslan, we need you on the board." I said, "Okay, let's talk about it." We're talking, and I realized that the only thing they care about isn't strategy or improving the quality of the company, but rather a certain protection of the company's management from pressure coming from above. I said, then I'm not the one you need. Get someone from the Verkhovna Rada or from the Cabinet of Ministers or from a committee, or do as our major mobile operator did when a very big name appeared on the supervisory board. That's a different matter. But who's doing the work? Who understands whether the chosen path, the strategy, is actually effective and relevant? You need professionals for that. That's why I always look at this mix. If that balance is maintained, there's no problem. If I see that the board is consistent in its decisions, and that's easy to check. Just look at 2 to 3 board decisions and it becomes very clear. That's a good sign. When it's not, it can lead to the company simply falling apart. And unfortunately, there are many such cases. Moreover, at some point, when everything starts going wrong, the owner begins to make yet another mistake. He has one board, and then he creates another board around himself, which leads to a complete conflict of interest. By the way, conflict of interest within the board also matters, as well as the quality of the board. Another point, yes, as I recall it now, when a company's board includes not even middle management, but representatives from other companies, I can see that this board is artificial, it's fake. That too is a signal, a red flag, that something is wrong. Also today, hygiene has become simply indispensable. This includes building ESG competencies within the board. Because in fact, yes, Trump stated that there's been some step back on this issue, but the European continent and most European leaders still support this agenda. And it's not just about the UN Sustainable Development Goals or something like that. It's about the quality of our lives, let's put it that way. Responsible business. That's why sustainability and support for this direction are important. Within the board, it plays a role. And for me, it's an additional advantage when I see that a company is developing this competency and that an ESG representative or someone with this expertise is present on the board. Another block, probably the last one, is the legal block within the company. That is, how the company is structured and how the board helps structure the company. When I see that after 2 years of the board's actions, it has essentially allowed a completely non-transparent company structure to remain, that's a signal for me That is, it's either a matter of having the wrong priorities, or an unprofessional board, or some mix of these issues.
Well, of course, by the way, the board or custom boards can theoretically allow such things because for a supervisory board, it's their obligation, their responsibility, and essentially their tragedy, if that's the case. When the full-scale invasion began, many owners disbanded their boards and CEOs and started managing things themselves. On the other hand, there's another trend, and let's say the vast majority of boards I've been involved with since the invasion were actually established after the invasion. That is, the owners most likely understood that the situation is very difficult now and it's necessary to bring in additional expertise in order to stabilize the situation in the company. In your opinion, and based on your experience, how useful can boards be specifically in times of war, uncertainty, and risk?
I see two stages in the creation of boards. They simply had different structural maturity. But the first wake-up call came during the pandemic, when the first challenge hit. Everyone was at home, everything was shut down, loss of markets, loss of clients, loss of effectiveness of the previous model of client interaction. During the war, this became an even more striking problem. And the BCP plan, evacuation of people, relocation, the company's unpreparedness for relocation, loss of markets. Because especially if we're not talking about something close to us like agriculture, right? When we talk about production, especially for those companies that were second-tier suppliers for European firms, meaning, for example, they made dashboard panels for BMW, but as a secondary supplier or some other finishing components, or collaborated with Boeing, they lost that market because no one could be sure whether that business would still exist tomorrow, whether it would be on occupied territory, God forbid, or whether something might strike it, and so on. And this reorientation required a rapid response to change. And the companies that already had boards in place were simply working 24/7. And I know such companies. I helped several companies myself, just on friendly terms. But there's one more sign: companies that suffered significant losses. And I just want to say thank you to all those boards. Because when the owner had no money to pay those boards, in 90% of cases, the board stayed on. And over time, that gave a multiplier of 300–400% growth for the company. And then the owner would repay everything to those people who worked for him. And I know several veteran-owned businesses that today have boards working entirely on a voluntary basis. Why is that? So that these businesses have a chance. Without a board, there's a major issue. Time, the ability to respond to shocks that arise, and the lack of expertise. That's why, especially during times of such risks as we face today, creating a board is simply a necessity. Filling that board, the number of people on it, that's a separate issue. But even then, I gave advice to a friend of mine who was facing serious problems in his business. I told him, you don't need 5, 6, or 7 people in the board, just take a few. You need to be in full coordination with these people. In other words, you don't have time for mistakes. That's the first thing. Second, it's about having a broader perspective on the market. And I appreciate when boards were able to relocate the company's operations and open up these very European markets. And we're seeing quite a few markets. Many examples. Take Nova Pošta, for instance, that's just massive expansion. Yes, of varying quality, but still massive expansion. We have great export directions where companies, just in a single day, at some point they heard something. Boards that were there and implemented this Greenleaf ecological standard, they fulfilled all of it. Boom. Market openings, Europe opened its markets, and today they export their products at rates ranging from 5 to 45%. In the markets they entered during the war, it's simply tremendous growth. So indeed, boards play a very significant role. And finally, it's the right structuring of the company. And during a crisis, the ability to take tough decisions. This is what differentiates companies that are capable of rapid change from those that will fall behind. And when you realize that your resources are limited today, it becomes difficult to act, whether it's cost-cutting, finding a co-investor, or deciding to exit. In fact, you never worked with banks. You had a no-credit model. There are such cases too, but you have to go for it. The foundation that has been laid in many companies today gives us hope for a positive outcome of this war for our country, sooner or later. But I see that those companies that have had established boards for several years already, they have significantly more adaptability and a better chance of being successful in the coming post-war years.
Ruslan, if boards are so useful in private business, then why are they still so rare in our market? Because the percentage of companies that have either an advisory or supervisory board is not very high.
It's a matter of financial literacy. or board literacy, if I can put it that way. There's a really great parallel. Back in 2005, no one insured their cars with comprehensive coverage until the car loans appeared in the banks. When the car loans appeared in the banks, the main covenant or condition was obtaining comprehensive insurance. But after that, the market developed, and eventually even non-credit cars started getting comprehensive insurance too, because customers saw the benefit of it, protection and so on. Word of mouth plays a very big role in our country. So when there were successful cases when the board that was created brought significant added value to the company, or some breakthroughs were made, the more of them there are, the more owners will rely on the board as an effective tool or take steps toward corporate governance. So basically, that's the key point. Today, this culture still doesn't exist. This culture needs to be built. There are as well a few centers that provide education related to corporate governance, and in my opinion, we still lack sufficient promotion of these educational centers, because if other centers pick this up, like MBA schools or KSC or other institutions that are currently quite popular and have launched high-quality courses, but it's important to maintain the standard. The problem often arises when these courses are developed. The standard tends to be significantly devalued. So if we have CGPA, UCGA, if we have other centers, we can see that there's a certain level, and that level needs to be upheld by others. In fact, this should become a separate direction, and most owners, they will see it, and they themselves should complete these courses. They need to understand what the added value is, what's inside, and then psychologically, they will come to the realization that they need to build boards. That's the first point. And the second thing to add is that we have this mindset of, this is mine and no one else's. And it's very difficult for owners to build trust with members of the board, because especially when these are fairly well-known people, there's always the temptation to think, oh, I might lose my business, right? First, how can I show all my notebooks with management reports to these people when later they might see me in some other context? So there's a psychological aspect to it, but it will gradually start to change. I would promote case studies more and more. I would create case studies of large companies, very transparent ones. I would show them to the guys. This was the defining strategy, and this is a case study of how we did it. Failures are also necessary. That is, in order to build a solid foundation. I always say, when you have a strong fundamentals, you can build everything else on top of it. These fundamentals are still being developed. It's an evolutionary process, you could say.
Okay, and what should a board be like in order to be truly useful and seen as a positive factor from the perspective of either an investor or a bank?
There needs to be a good balance between strong leadership. Someone has to be a very powerful leader within, and most likely that would be the chair of the board. It's a certain group of highly structured, experienced professionals with a good reputation and track record, who will focus more on strategy and the company's framework, and deep experts in the company's field of activity. It's a combination meant to avoid building a kind of Galacticos team like Florentino Perez did with Real Madrid back when he bought everyone, and for some reason didn't win anything in the first year, because when you only have stars, it doesn't always work. And this balance will be very indicative both for financing organizations and for others. That is, even today there are several markets that I see that existed, built on the principles of the Galacticos. And I already see certain signs that the owners are beginning to understand this and are trying for now to add someone by expanding these boards. But that's also bad. It's not a coincidence that there are 11 players on the field, not 15, right? The same applies to boards, so this balance is important. And even more so, I'll say this. If you have deep relationships with a certain financing organization, let's not even talk about Ukrainian banks. For example, you're being financed by DFIs, EBRD, IFC, or others. It's better to have a representative from them on the board because it provides reassurance that the strategy of the organization is aligned, not only yours, but also that of the entity you depend on in terms of financial resources. That's why I would include someone like that, because often these colleagues are highly professional as well as their names. Will play a role in expanding access to financing further on, when going public on IPO. In Washington or Warsaw or London, they might not know someone local here, but when there is an ex-World Bank or ex-EBRD or ex-IFC person involved, it always plays a significant role. And today, by the way, this is a bit broader than our main topic, but I see quite a significant interest from hedge funds are showing interest in coming to Ukraine for the rebuild. And I see how their boards are being formed. And I see when some major people who had quite significant exposure in major international organizations are now becoming the frontmen of these funds. And that's a very good sign because it makes it much easier to conduct KYC on these funds when you understand that this person is vouching for the origin of the money. And in business, especially when the business comes from the former Soviet Union, where there is still a certain perception abroad of a lack of transparency, and when there is strong representation on the board, it allows that perception to be immediately reduced from negative to neutral and to simply understand the company based on facts.
Great. Ruslan, thank you very much for a very interesting and insightful conversation.
Thank you for having me. It was a real pleasure.
Ladies and gentlemen, see you next time on Boards of Directors with Sergiy Bulavin channel.